Assalamualaikum warahmatullahi wabarakatuh. So now we are going to present our financial analysis from the chosen company, which is we choose Maybank. So we are from group 2 that consists 5 members, which is me, Nurul Ana Fahada binti Izani.
My name is Nurul Izni binti Ahmad Nazrai. My matric number is 2315618.
My name is Nur Shahila, matric number 2315080.
My name is Nur Amira binti Ahmad Zaidi, matric number 2314152.
My matric number is 2317030.
Okay, so now I'm going to tell about Maybank, like introduction of Maybank. So first of all, Maybank is Malaysian universal bank that operates in Malaysia, Singapore, and also Indonesia. It was founded on 31 May 1960 by Khoo Teck Puat and Muhammad Azri bin Subuhi. Maybank also is one of the company that was listed in Bursa Malaysia as a public company. Also, Maybank have been recognized as one of the world's strongest bank, which is Bloomberg Markets. And then one of the future strategy or future plan that Maybank have been decided was to build on M25 Plus. Why they choose the title M25 Plus? Because it was the Maybank Group strategic business plan for the period of 2025 and beyond, which is it was built from 2021 until 2025 and the next years. And then some of the strategies is to accelerate digital transformation, where Maybank want to improve their online transfer like Maybank to You or MAA. And then Maybank also want to focus on ESG, which is embedding sustainability by supporting the green financing and responsible investment.
So now I will be presenting the analysis of Maybank's profitability ratios for the period 2020 to 2024, which includes net profit margin, gross profit margin, operating profit margin, return on equity, and return on asset. Let's begin with the net profit margin. This ratio peaked in 2021 at 17.6%, reflecting strong post-pandemic recovery. However, it declined slightly to around 14.6% by 2024, suggesting margin pressure from rising costs and interest expenses. Next is the gross profit margin, which estimated using net operating income. It reached a high of 50.4% in 2021, but dropped to approximately 43% in the last 2 years. This decline highlights increased operational and funding costs that reduce the surplus generated from revenue. As for the operating profit margin, it showed strong performance in 2021 and 2022, peaking at 23.8% by 2024. It stabilized at 9.5%, which still indicates that Maybank managed its core operation efficiently despite external pressures. Moving on to ROE, this ratio remained consistently high above 29%, with a rise to 31.47% in 2024. So this shows that Maybank continued to deliver strong returns to shareholders. Lastly, we observe a slight decline in return on asset ROA from 2.89% in 2020 to 2.66% in 2023, followed by a small recovery to 2.75% in 2024. So this indicates while shareholder return was strong, asset utilization could be further improved. In conclusion, Maybank has demonstrated stable profitability with strong equity return though there is room to enhance efficiency in managing its asset and operating margins. So I will pass to the next presenter. Thank you.
So now I will continue with financing ratio. So financing ratio is when it measures the extent to which a company use the debt to finance its operation. Higher ratio indicate greater financial leverage and also risk. So from the table, we can see the summarization of ratio from 2020 until 2024. The first one is debt ratio. If you guys can see, it shows the increasing of ratio by year. So it indicates the increasing reliance on liabilities to finance assets. And then for the debt equity ratio, it reflects also the increasing by year. So when you have increasing ratio, which is debt equity ratio, it means the company relies more on borrowed money from loan or bonds than on the shareholder fund. And then the last one is time interest earn ratio. Okay, so from 2020 until 2021, you can see the increasing, but start from 2021 until 24, it show the decreasing part. So it declines again. So it indicates weakening the ability to meet the interest payment. So I think that's all from me. Thank you. We will go to the next person.
Okay, now I will continue the presentation. My name is Nur Shahila, metric number 2315080. So let's begin with a quick definition. Liquidity ratios measure a company's ability to meet short-term obligations using its most liquid assets. This ratio helps assess whether a business can cover immediate liabilities without relying on offset funding. First, we'll examine the current ratio. The current ratio evaluates a company's ability to pay off its short-term liabilities with all of its current assets, like cash, receivable, and inventory. The formula is simple. We have to divide the current asset by current liabilities. And then a ratio above 1 is considered healthy, while a ratio below 1 may indicate potential liquidity concerns. So now, let's take a look at Maybank's current ratio over the 5-year period. In 2022, the ratio was 0.1716 or 17.16%. This was the highest in the 5 years, reflecting relatively strong short-term liquidity at the time. In 2021, it dropped slightly to 0.1513, indicating a reduction in liquidity, possibly due to increased liabilities or a decrease in current assets. By 2022, the ratio declined further to 0.1239, pointing to rising pressure on Maybank's ability to cover short-term obligations. While in 2023, the figure hit a low of 0.1196, the weakest point in the 5-year period, raising concern about liquidity tightness. Finally, in 2024, there was a modest rebound to 0.1386, though still below the ideal benchmark. This suggests early efforts toward improving liquidity, perhaps through better asset management or reduced liabilities. So next, let's examine the quick ratio, a more conservative measure of liquidity. So unlike the current ratio, the quick ratio excludes inventory and focus only on the most liquid asset. The formula is current asset minus inventory and then divided by current liabilities. A quick ratio greater than 1 implies strong immediate liquidity. Now let's review the quick ratio figures for Maybank. In 2022, the quick ratio was 0.1716, identical to the current ratio, and the strongest of the 5 years. This shows a relatively good ability to meet short-term debts using only the most liquid assets. In 2021, it fell to 0.1513, suggesting a shrinking liquidity buffer. In 2022, the quick ratio declined further to 0.1239, indicating tighter liquidity and reduced flexibility. In 2023, the lowest point was reached again at 0.11696, reflecting significant vulnerability in covering short-term liabilities with liquid assets. In 2024, the quick ratio improved slightly to 0.1386, showing some recovery and better financial positioning. So, in conclusion, both the current and quick ratios showed a steady decline from 2020 to 2023, reflecting increasing liquidity pressure, likely driven by post-pandemic economic challenges. However, in 2024, both ratios showed a modest but meaningful rebound. This signals that Maybank is making progress in strengthening its short-term financial health. So, while the figures still fall below ideal benchmarks, the upward trend is encouraging and its targets are improved liquidity management, greater financial resilience, and growing investor confidence in the bank's recovery path. So that's all from me. I will now pass the floor to the next presenter.
Okay, so for this part, I'll be explaining the activity ratio, specifically focusing on the asset turnover ratio, which is the most relevant activity ratio for banks like Maybank. So the formula is simple, which we use operating revenue divided by the total assets. So this ratio tells us how efficiently the bank is using its asset to generate revenue. As we can see from the table, in 2020, Maybank showed a relatively efficient performance with a ratio of 0.0596. However, in 2021, the ratio dropped to 0.0517, mainly due to economic disruption from COVID-19. And there was a slight recovery in 2022, and by 2023, the ratio increased significantly to 0.0618. In 2024, Maybank achieved its highest efficiency within this 5-year period at 0.0641, showing a strong ability to generate revenue from its asset. Now, moving on to the second slide, which is we clearly can see the trend from this graph. The sharp dip in 2021 followed by a gradual but consistent recovery. This upward trend reflects Maybank's resilience and adaptability in managing its resources after the pandemic. In summary, the asset turnover ratio shows a positive outlook on Maybank's asset utilization, with 2024 being the strongest year so far.
So, for the weaknesses, first we can see that Maybank return on asset dropped from 2000 to 2023, which show that the bank become less efficient in using its asset to regenerate profit. Second, both current and quick ratio is very low, especially in 2023. This means that Maybank might have problem in covering short-term debt by using their current asset. Third problem is the asset turnover ratio was very low in all 5 years. This tells us that Maybank is not fully maximizing its asset to generate more revenue. Last problem is Maybank had a high level of debt and its interest coverage also decreased. So this shows that the higher financial risk if the Maybank income is dropped or interest rate increase.
Now moving on to our recommendations for profitability and liquidity ratios. So under profitability, first Maybank should optimize underperforming assets and consider divesting from low yield investment to focus on higher returns. Second, they should diversify income streams, especially through fee-based services and digital banking, which are scalable and stable sources of revenue. Third, implementing the cost efficiency measures can help improve profits margins by reducing unnecessary expenses. For liquidity ratios, our first recommendation is to increase high quality liquid assets or HQLA to strengthen short-term financial stability. Second, Maybank should enhance cash flow forecasting and conduct regular liquidity stress tests to stay prepared for market uncertainties. And lastly, the bank should promote CASA deposit, that is current and savings account, as they are cheaper sources of funds and help to improve the liquidity. So now I'll pass to the next presenter.
Moving on to activity ratios, there's a clear opportunity for Maybank to enhance its asset turnover. The focus should be on maximizing revenue from existing assets, particularly by improving loan yields and expanding service offerings across customer segments. Cross-selling strategies and better asset productivity will be key here. Additionally, investing in technology to automate and streamline processes can significantly boost operational efficiency and customer experience, especially in retail and SME banking. Another important step is to reallocate resources toward higher yielding, better performing business segments. This ensures that underutilized assets are shifted to areas that drive stronger returns, ultimately improving overall asset efficiency. Turning to financing ratios, a gradual reduction in Maybank's debt to equity ratio should be prioritized. This can be achieved through retained earnings, selective equity issuance, or simply limiting future debt intake. Such action will help strengthen the capital base, improving solvency and reducing financial risk. In tandem, the bank should look at managing interest obligation more effectively, ideally by securing long-term fixed rate debt during favorable market conditions. Stabilizing earnings through diversified revenue stream will also help improve the times interest earn ratio. This reflects Maybank's ability to meet interest obligation consistently, even under fluctuating market conditions. So that's all from us. Thank you everyone for your attention.